Diana is a 38-year-old marketing director in Charlotte, North Carolina. She is highly disciplined. Her household brings in $186,000 annually. She maintains an elite credit score, and she has spent 4 years saving a massive cash down payment. Armed with those financials, she targets a 4-bedroom dream home priced at $812,000. Her bank approves the loan without hesitation, setting her monthly mortgage payment at $3,940. Most people assume that if they can afford the monthly mortgage payment, they can afford the house. This belief is the foundational premise of almost every real estate transaction in the country, and it is incomplete. Online mortgage calculators, bank approval letters, and realtor conversations are designed to measure the initial cost of entry. They rarely account for the long-term liabilities that arrive after the keys change hands. Treat the mortgage strictly as an entry fee. The actual cost of owning the asset is a much larger figure that only begins with that monthly payment. To find the real numbers, we have to audit a hidden balance sheet. It's divided into 3 specific categories: holding costs, lifestyle creep, and invisible costs. Holding costs begin with the square footage tax. Heating and cooling a larger home scales aggressively because extra exterior walls, more windows, and independent climate zones require significantly more energy to regulate. In her previous townhouse, Diana paid $2,400 a year for utilities. In the new home, her annual bill surged to $6,840, a square footage tax that never appears on a mortgage calculator. Next, her homeowner's insurance premiums rise to $4,200 annually. High-value homes often see rates 3 to 4 times higher than entry-level properties due to the complexity of custom finishes and larger liability exposure. Then comes the 1% maintenance rule. Simply preserving an $812,000 home against decay requires a budget of roughly $8,000 a year. Between a failed HVAC compressor and minor plumbing leaks, Diana spent over $9,000 in her first year alone. This larger physical footprint creates a cascading, unavoidable drain on monthly cash flow that persists regardless of how carefully a family budgets. Beyond physical upkeep, the house dictates how you live. Homeowners face a psychological compulsion to fill dead space with appropriately scaled furniture, so their old belongings don't look like doll furniture in a hotel lobby. Diana spent over $22,000 to furnish rooms she didn't previously own, financing nearly half of it at 21% interest. This is part of the neighborhood budget, an invisible social pressure enforced by homeowner association standards and visible peer consumption. To match the community's standards for landscaping and outdoor aesthetics, Diana spent an additional $7,200 per year. She made these purchases without ever sitting down and deciding to spend a penny. These expenses are the psychological tolls paid to defend the identity of a dream home owner. The most insidious drains on wealth are the ones that are completely out of the owner's control. In appreciating markets, property tax reassessments can turn a fixed housing cost into a volatile moving target. Following a 30% rise in Charlotte home prices, Diana's annual property tax bill increased by over $3,300. This is a permanent penalty for owning a home that the market says is worth more. When you try to leave, you encounter exit friction. The commissions, title fees, and staging costs required to sell a home can consume 7 to 8% of the sale price, vaporizing years of equity gains. There is the opportunity cost of the down payment. Diana converted $162,000 of liquid capital into an illiquid stake in a single asset. That same $16,000 left to compound in a standard market index for 20 years, would have grown to nearly $2 million. Illiquidity and massive opportunity cost are structural features of the product, baked in from the day the papers are signed. When we tally the balance sheet, the $3,940 entry fee mortgage becomes a crushing $96,120 annual operating cost. This house now consumes 69 cents of every dollar Diana earns. To keep it, she dropped her retirement contributions from 14% to just 4%. Real estate marketing uses the term dream home to fuse a financial transaction with emotional identity. Tactics like professional staging and curated lighting are designed to move buyers from their analytical brain to their emotional one before an offer is made. When Diana signed the papers, she was purchasing public proof of who she had become after years of work. She was no longer altering an asset. She was defending a 16-year vision of herself. Buying a home the right way requires rigid rules. First, your total housing costs, including maintenance, taxes, and utilities, should never exceed 28% of your gross income. Second, keep your down payment below 30% of your total liquid investable assets. You must preserve your ability to compound wealth in the markets. Finally, evaluate every home against a 20-year cost model. Account for exit friction and the lifestyle burn rate, ruthless, unemotional accounting of its total cost.